All right, let's get right into it. We're about to pull back the curtain on a wealth strategy that you usually only hear about in whispers, as a secret of the super rich. But here's the thing that's so fascinating. The actual mechanics behind it, they're becoming way more accessible than you might think. We're not just talking about billionaires here. Thanks to tools like securities-backed lines of credit, this is a playbook that's suddenly open to a lot of regular investors, folks with portfolios of $100,000 or more. Yep, we're talking about buy, borrow, die. I mean, this quote right here just cuts straight to the heart of the problem, right? It's the ultimate frustration for any successful investor. You do everything right, you work hard, you make these smart calls, you watch your portfolio grow, and then what happens? The second you want to actually use some of that money, bam, you have to write this massive check to the government. It almost feels like you're being penalized for doing well. So that really tees up the central question we're going to tackle. If selling your assets is so incredibly expensive from a tax perspective, how in the world do savvy investors pay for their lives, buy a house, or pass on wealth without constantly chipping away at their investments and getting hammered by taxes? Well, turns out there's a playbook for it, and we're going to walk through every single step. Okay, first things first, to really understand why the solution is so brilliant, we have to get our heads around the problem. And that problem is what I like to call the investor's tax trap. It's this fundamental hurdle that puts a major drag on building wealth over the long term. And this number, this is the villain of our story, 20%. In the US, for investments you've held for more than a year, the federal long-term capital gains tax can get all the way up to 20%. And that's not even counting state taxes. The painful part is it's not a one-time thing. It's a cost you pay every single time you sell. And every single dollar you send to the IRS is a dollar that's gone for good, a dollar that will never ever compound for you again. And this right here illustrates the two paths you can take perfectly. Over on the left, you've got path A. You need some cash, so you sell. Instantly, your capital base gets smaller. That tax money is just gone. It can't grow for you anymore. But look at path B on the right. You hold on. That tax bill, it's deferred. It's just an unrealized gain, which means your entire portfolio, gains and all, keeps working for you. It's what Warren Buffett has been saying for decades. One of the best things you can do for your portfolio is simply stay out of the taxman's way by holding on. So, if holding on is the goal, how do you get cash to actually live your life? And that brings us to the playbook itself. It's a three-part philosophy that totally flips the script on how you should think about accessing your own wealth. So here it is, the 3 simple steps. First up, you buy. Pretty straightforward. You acquire assets you think are going to grow over the long haul. Stocks, real estate, whatever. That's the engine. Then comes the really clever part, borrow. This is the absolute key. Instead of selling those assets to get cash, you use your portfolio as collateral and take out a loan, usually at a really low interest rate. And because a loan isn't considered income, guess what? It's not a taxable event. And finally, die. Yeah, I know it sounds a little morbid, but honestly, this is the final, and you could argue the most powerful piece of the entire tax puzzle. See, when you pass on, your heirs get those assets at whatever their market value is on the day you die. It's called a step up in basis. So if you bought a stock for, say, $10 and it's worth $1,000 when you're gone, your heirs get it with a new cost basis of $1,000. That whole $990 gain, poof, it never gets taxed. The slate is literally wiped clean for the next generation. So let's really zero in on that borrow step, because this is where all the theory turns into a practical tool you can actually use. How exactly do you turn a big portfolio of stocks and bonds into cash without selling a single share? The main tool that makes this all possible is something called a securities-backed line of credit, or an SBLOC for short. Now, this is not the same as a margin loan. A margin loan is usually for buying more stocks, and it's a lot riskier. An SBLOC is different. Think of it more like a home equity line of credit, but instead of your house, it's backed by your investment portfolio. It's a flexible line of credit you can draw on for anything, living expenses, a down payment on a house, you name it. Okay, so the big question is, how much can you actually borrow? Well, that all comes down to a key metric called loan to value, or LTV. It's a really simple ratio, just the amount of the loan divided by the value of your collateral. Lenders use this to figure out their risk. The basic idea is, the safer and more diversified your assets are, the more money they're willing to lend you against them. And this table gives you a fantastic sense of how this works in the real world. So if you've got a well-diversified stock portfolio, maybe just an S&P 500 index fund, a bank might lend you 50, maybe even 70 cents for every dollar of value. But if your portfolio is just one big concentrated stock position, that's way riskier for the bank. So your LTV is going to be lower. Think 30 to 50%. And then you have something super stable like high quality bonds, and you can get an LTV as high as 90%. So you can see how the way you build your portfolio directly affects how much cash you can access. So why on earth would you go through all this trouble of setting up loans and tracking LTVs? Well, let's just look at the simple math. The moment you compare the cost of borrowing to the cost of selling, the power of this strategy becomes crystal clear. This slide just lays it out perfectly. On the left, selling is like setting a chunk of your money on fire. To get your hands on that cash, you pay a huge tax, let's say 20 grand, and that money is just gone forever. But on the right, borrowing is more like turning on a faucet. Sure, you pay a little bit in interest, but your entire asset base is still in the market, still invested, still working for you. And that creates this amazing trade-off. As long as your investments are growing faster than the interest rate on your loan, you're basically paying for your lifestyle while your net worth keeps going up. It's an incredible arbitrage opportunity. Okay, I know, this all sounds a little too good to be true. But borrowing money against a volatile asset like the stock market is, by its very definition, using leverage. And leverage, my friends, is a razor-sharp double-edged sword. So it's time for a dose of the brutal truth about the risks you're taking on. I mean, who better to quote on this than Warren Buffett? He just nails it. When you use leverage, you're pouring gasoline on the fire. You amplify your wins, for sure, but you also amplify your losses. And if things go south, they can go south in a way that is absolutely catastrophic. This is no free lunch. You are absolutely taking on major risk in exchange for that tax savings. A lot of people assume the biggest risk here is that interest rates will shoot up and make the loan too expensive. And look, that's a risk, no doubt, but it's not the biggest one. It's not the one that can wipe you out. The real portfolio-destroying monster hiding in the closet is the dreaded margin call. Let's just walk through this absolute nightmare scenario, domino by domino. First, the market tanks. I'm talking a 30–40% crash. The value of your portfolio, the denominator in that LTV math, just got crushed. All of a sudden, your loan is way too big for your collateral. Then the phone rings. It's the bank. You've breached your LTV ratio, and they need you to fix it, now. That means either depositing more cash or selling assets. If you don't have the cash just sitting around, the bank has the right to start selling your stocks for you at the absolute bottom of the market. And the final kick in the teeth? That forced sale is a taxable event. So you lock in your massive losses, and you trigger the giant tax bill you were trying to avoid in the first place. It is a devastating 1-2 punch. This famous line from John Maynard Keynes just captures the danger perfectly. You could be the smartest investor in the world. You could know deep in your bones that the market will eventually come back. But it doesn't matter. If you are over-leveraged, a short-term panic in the market can force you to sell everything and wipe you out long before you have a chance to be proven right. So we've seen the incredible tax benefits, and we've stared into the abyss of the catastrophic risk. What this all means is that buy, borrow, die isn't some magic trick. It's an incredibly powerful financial tool, and like any powerful tool, it has to be used with a ton of discipline and respect. So how do you use this tool without getting burned? Well, there are some clear rules of the road. First, and this is the most important one, use low leverage. Just because a bank is willing to lend you 50% of your portfolio's value doesn't mean you should take it. Keep your borrowing under, say, 25 or 30%. That creates a huge safety cushion. Second, have cash reserves somewhere else. If that dreaded margin call comes, you want to be able to meet it with cash, not be forced to sell your stocks. Third, you got to understand this is a strategic tool, not a blank check to fund a crazy lifestyle. And finally, stress test your plan. Run the numbers. See exactly what would happen to your LTV in a real market crash before it happens. So when you boil it all down, this strategy presents a very clear trade-off. You're swapping the certainty of paying taxes for the uncertainty of taking on leverage risk. For some people, that is a fantastic trade. For others, it's a recipe for disaster and a lot of sleepless nights. There's no one right answer. It all depends on your own financial picture, your level of discipline, and your personal tolerance for risk. So the real question I want to leave you with is this: where does that trade-off fit for you?